Welcome back to Factful Finance, the place where smart money moves happen, and today we're diving into something crucial to every financial decision you'll ever make: the role of risk and return. But before you tune out, let me ask you, what if I told you the way you're thinking about risk could be holding you back from making smarter, more profitable financial choices? Stick around to find out how to avoid that. If you've ever felt a bit overwhelmed when making investment decisions or unsure about how much risk you should take on, you're not alone. It's a common dilemma. On one side, you've got the allure of high returns, and on the other, the fear of losing it all. But here's the truth. Understanding how risk and return are tied together is key to unlocking financial success. Let's kick this off by breaking down what risk and return really mean in financial terms. Return refers to the profit or loss you make from an investment, often expressed as a percentage of the initial investment. Risk, on the other hand, is the likelihood of that return being different from what you expected. It's not just about losing money, it's about uncertainty. The more uncertain an investment is, the higher the potential risk, and typically, the higher the potential return. Now, why does this matter? It all comes down to decision-making. Whether you're a seasoned investor or just getting started, your ability to understand and manage risk and return can make or break your financial strategy. Investors often face a trade-off. Do you go for the higher risk with potentially higher returns, or play it safe with more stable but lower returns? Let's make it more concrete. Imagine two people, Liam and Olivia. Liam is all about high-risk investments. He's the kind of guy who puts his money into volatile stocks, hoping for a big payoff. Olivia, on the other hand, prefers to invest in bonds, which are less risky but offer lower returns. Over time, Liam's portfolio can be subject to wild swings, sometimes huge gains, sometimes losses. Olivia's portfolio grows more slowly but steadily. This is where we bring in the concept of risk tolerance, your ability to handle uncertainty in investments. For Liam, he's got a higher tolerance. He's comfortable with the roller coaster ride because he knows that, in the long run, he might see a higher return. Olivia, however, has a low tolerance for risk. She doesn't want to lose sleep over market downturns, even if it means slower growth. But here's the thing. Even if you have a low tolerance for risk, understanding the balance between risk and return is still crucial. Because let's face it, safely parking your money in a savings account won't help you beat inflation or grow your wealth. So finding that sweet spot between security and growth is vital. That's where asset allocation comes in. For example, let's say you're saving for retirement. You could go all in on bonds and expect modest growth, but your savings might not keep up with inflation over time. If you balance that with some equities, though, you can boost potential returns. Sure, you take on more risk, but over time, the stock market has historically outperformed more conservative investments. The key here is understanding your own risk appetite and how long you plan to keep your money invested. Of course, no one wants to gamble away their hard-earned cash. So this is where diversification becomes your best friend. By spreading your investments across different asset classes, stocks, bonds, real estate, etc., you reduce the impact of any single investment's poor performance on your overall portfolio. This doesn't eliminate risk, but it can help you manage it. Now let's talk about how all of this plays into the bigger picture. According to the CFA Institute, investors can use various tools like the Sharpe ratio or the capital asset pricing model, CAPM, to calculate and assess the risk-return trade-off. These models help you understand the expected return of an investment relative to the risk you're taking on. For instance, the Sharpe ratio can tell you if the returns you're getting are worth the risk you're taking. But here's the kicker. Even with all the tools and calculations, the future is uncertain. Markets fluctuate, economies change, and unpredictable events, think global crises or technological breakthroughs, can shift the landscape overnight. That's why risk management isn't just about numbers. It's also about being adaptable and continuously reassessing your strategy as things evolve. Ultimately, managing risk and return isn't a one-time decision. It's a dynamic process. The choices you make today should align with your long-term financial goals. And like Liam and Olivia, your strategy may evolve over time as you grow more comfortable with risk or as your financial situation changes. So, let's put this into action. If you're looking to take your finances to the next level, think about where your risk lies. Are you diversifying enough? Are you comfortable with the risk levels of your current investments? And are you positioning yourself for the returns that match your goals? If you found this breakdown helpful, you'll want to stick around for more in-depth financial strategies coming soon. If you've got any questions about risk or return, drop them in the comments below. I'm here to help. Remember, this content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. Looking to level up your financial strategy? You won't want to miss the next video. Click the one on screen right now.